And today we're going to look at the portfolio Monte Carlo. So what this does is it allows you to put in the volatility of an asset, and it runs 100 simulated 10-year paths based on the volatility and your expected return on the assets and all these other factors. It's more typical that they run 1,000 scenarios, but this is just a browser-based one, and I just simply made it 100, and you can randomize the scenario, you can adjust things, you could basically refresh, and you'll get another randomized multitude of scenarios. So let's take a look at a simple scenario here. Let's say you have $1 million that you want to retire on, and you're planning to do that today. You're going to set aside 10% of that in cash as a buffer. This is not a bad idea. We can adjust these things and see the probability of success change. Your annual spend is going to be 100K as well. Your inflation rate, we could go to maybe between 3 and 5%. This actually affects your annual spend. So it's going to increase at the rate of inflation or debasement. We're just going to leave it at 5% for now. Asset volatility, we've done 40%. If you expect Bitcoin to be more volatile, or if you want to really bulletproof this scenario, you could increase volatility, and that's going to lower the probability of success here. Or this is a different asset that has a lower volatility. You can lower the volatility, and the volatility impacts the probability of success quite a lot, because what you have to do is you have to sell this asset to fund 1 year of liabilities. And because of the volatility, if the volatility is high, there could be a year where you're selling quite a lot of it because the price has gone down a lot in that year because of the volatility. The expected annual return, this is obviously going to affect the probability of success quite a lot. And then a tax rate. So we're just saying this is long-term capital gains. Maybe you can get a tax rate of about 15% from selling this and having the capital gains appreciated at this. So this tax rate is just taken from the total of selling, which increases the amount you have to sell. So if you lower this as well, your probability of success is going to go up as well based on that. So we're going to keep everything here the same. And then we look here and we actually see this purple line is the most middle of all of the scenarios. And then we actually have all these gray lines that are showing the other 99 scenarios. And what you can do here is you can hover over this. You can see that this specific path goes from 1 million to 1.1 million. So it's actually gone up the first year. And the typical range, so the 10th and the 90th percentile of this is either the portfolio is worth 678K or 1.6 million. So no paths are gone to zero yet at this point, and we can kind of see the typical range is going to expand on both ends because of the volatility. You have a potential of a terrible path, that volatility going to the downside year over year, and you losing the amount, or the volatility going to the upside, and then you have the middle rung here. So we can see here on year 3 of these simulated paths out of 100 have actually gone completely bust. All of the money is gone from you withdrawing $100,000 plus the inflation rate. And that's because of the volatility of this asset. And if you go down further and further, you can kind of see all the way to year 10, where 31 out of 100 paths have gone bust, which gives you a probability of success for a 10-year period of 69%. So on average, your portfolio will be 1.6 million. So it's increased. You have the possibility of it being 0. You have the possibility of it being 10.7 million, and anywhere within that range by the 10th year based on these inputs. Don't second guess that your Bitcoin is safe. Get a security audit through a one-on-one session with me, and join the school community, the Bitcoin Masters, to meet other Bitcoiners, grow your network, and grow your net worth.